Welcome to your daily 5 minutes market brief with JP Morgan and Luna. Today is August 15th, 2025. I am Luna.
I am JP Morgan.
Okay, so yesterday, well, it felt like a real tug of war. You had this policy optimism fighting against some pretty stark inflation reality.
How did that play out in stocks? Flat mostly?
Pretty much flat for the major U.S. indexes, yeah. We saw this early rally, based on hopes for interest rate cuts. But that got knocked back pretty quickly by an inflation report that was, well, hotter than anyone really expected.
So some divergence even within equities.
Definitely. Tech stocks actually managed to do okay. They outperformed. But your smaller cap shares, like the Russell 2000, they lagged quite a bit, down maybe 1.2% intraday.
Interesting split. And the bond market. Did it reflect that same kind of tension?
It did, yeah. U.S. Treasury yields definitely showed those mixed signals. But what's really striking, I think, is how unusually calm the bond market stayed overall.
Calm, even with that inflation news.
Right. Treasury volatility, the MEE index, it stayed near a 3-year low. So this calm, even with stocks bouncing around, it gives a sort of quiet foundation.
But is it a reliable calm? Or maybe deceptive?
That's the million-dollar question, isn't it? Something to watch.
Okay, zooming out a bit, commodities, currencies, what were they telling us?
Well, oil prices were hovering near those 2-month lows, around $66, $67 a barrel. Initially, there was some hope about easing geopolitical tensions.
Gold.
Gold ticked up a bit, maybe some safe haven seeking there. Copper saw small gains too, possibly on those whispers about future stimulus in China.
And currencies were moving too.
They were. The U.S. dollar index firmed up a little, maybe also reflecting some caution. Meanwhile, the Japanese yen and the British pound actually hit multi-week highs against some other major currencies, so a mixed bag globally.
And the big risk barometer, Bitcoin. What was happening there?
Oh, Bitcoin surged, flew to a new record high, actually above $124,000 before it settled down a bit.
Wow.
Yeah, that was definitely part of that initial risk-on feeling tied to hopes for, looser money.
Okay, that sets the scene perfectly. Let's dig into the economic data now, because that seems to be where the mood really shifted. Some real curveballs yesterday.
Absolutely. The U.S. Producer Price Index, the PPI for July 2025, that was a big one.
How big?
It jumped 0.9% just month over month, and that pushed the year-over-year rate up to 3.3%, way higher than forecasts.
Oof. So that really put a damper on things.
Oh, yeah. That surprise surge basically just crushed investor hopes for a big, like a 0.5% rate cut in September. Risk appetite definitely cooled off fast after that. It just shows how sticky inflation still is.
Right. So hot inflation. But the job market in the U.S. still looks pretty solid.
It does. Initial jobless claims came in at 224,000. That was actually slightly better than expected. So yeah, it points to a still resilient labor market.
So the Fed's got this balancing act. Strong jobs, but persistent inflation.
Precisely. A tricky position.
And turning to China, I heard something about a really shocking contraction there.
Stunning is the right word. China's new yuan loans for July, they actually fell by 50 billion yuan. Everyone was expecting an increase of around 300 billion.
A fall.
Yes, the first monthly decline in Chinese bank lending in like 20 years. It signals potentially serious economic weakness, which, could ripple outwards.
Wow. Okay. How did Europe and Japan look amidst all this?
A bit mixed there, too. Eurozone industrial output dipped in June, but their Q2 GDP just managed to squeak out 0.1% growth, so they avoided contraction, but just barely. Contrast that with the UK, their Q2 GDP grew 0.3%, which beat forecasts, showed a bit more resilience. And Japan also beat expectations, Q2 GDP up 0.3%, mostly driven by strong business investment.
And France. Low inflation there.
Exceptionally low, yeah. Confirmed at just 0.9% year-on-year for July.
So the big theme from the data seems to be this.
Well,
policy divergence, right? U.S. inflation's hot, but the rest of the world is this patchwork quilt.
That sums it up perfectly. Different central banks are facing really different challenges right now.
Okay, let's pivot to the macro events. The market mood really did a complete 180 yesterday, didn't it?
It was fascinating to watch, a real whipsaw. Early on, you had these really strong bets on the Fed being dovish. Even Treasury Secretary Scott Bessent suggested a possible 50 basis point cut in September.
And that drove markets up initially.
Absolutely. Stocks hit fresh all-time highs. Bitcoin hit its record. It was all fueled by that rate cut speculation.
But then came the PPI report.
Exactly. Just hours later, that hot inflation number swiftly tempered that whole Fed cut outlook. The mood changed dramatically, almost instantly.
A reality check.
A big one. It really highlighted the risk that maybe the markets got way ahead of themselves on rate cut hopes.
But you mentioned the Treasury market stayed calm through all this.
Yeah, that's the intriguing part. Despite all the drama intraday, that MOVE-E index stayed low. It provided this weirdly stable foundation, even as stocks were reacting.
And oil prices. You mentioned geopolitics earlier. How did that play out?
Right. Oil stayed low partly because people were looking ahead to the U.S.-Russia summit, hoping for eased tensions. But then expectations kind of shifted towards a more limited outcome, so those Ukraine peace hopes also seemed to fade a bit.
So the lesson from the last 24 hours is guarded optimism and flexibility.
I think that's fair to say. Guarded optimism and definitely market flexibility. Things can turn fast.
So looking ahead now, what specific data points should we be keeping an eye on next?
Okay, for Monday, August 18th, there are a few things. You've got the New York Fed Business Leader Survey at 8:30 a.m. Eastern.
Okay.
Then the NAHB Wells Fargo Housing Market Index at 10:00 a.m. Eastern. And finally, the NY Fed Survey of Consumer Expectations, specifically the labor market part, at 11:00 a.m. Eastern.
Got it. So these are maybe second-tier indicators, but they'll still help paint the picture, right? Set the stage for bigger things later.
Exactly. They're important pieces of that broader economic puzzle we're trying to put together.
Well, as this deep dive into the JP Morgan and Luna daily 5-minute briefing clearly shows, markets can pivot and pivot really fast.
They certainly can. And maybe that brings up an important question for you. Listen in. How do you stay flexible? How do you avoid getting complacent when maybe the market feels calm, unusually calm even, but you know these rapid shifts are always possible?
It's about staying vigilant, staying informed, and just being ready to navigate whatever comes next in this evolving landscape.
You've seen the headlines, but what really moves your portfolio? Money.ai scans 1.3 million signals a day, earnings, sentiment, macro shifts, and turns it into one personalized briefing focused on your holdings. No noise, no guesswork, just what matters. Money.ai, know what moves your money.